It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. First, I need to welcome a number of new listeners. We have several new stations joining us this week, but I want to welcome Atlanta, Detroit, Tampa, Baltimore, Honolulu, Knoxville, Colorado Springs, Little Rock, and Chattanooga, all new stations joining us this week. Welcome to the Your Personal Bank Show. The first thing I should probably do is share a little bit about myself and then what is your personal bank. First and foremost, I'm a Christian, have been for over 3 decades, and my faith is important to me. I'm not perfect, but I try to do the best to be a good person, and hopefully my walk inspires other people. I'm a husband of nearly 24 years. My wife is my partner, my best friend, my confidant. She's my secret weapon, if you will, and a big part of my success. I'm a father of 2 young ladies that have grown into quite amazing young women. I'm proud of both of them. I'm an entrepreneur. I've owned a number of different businesses, from a retail to real estate, a financial business, and I was even chairman of the board of an FDIC-insured bank in formation for a while. I'm the founder and owner of Your Personal Bank. We have over 5,000 clients we've developed over the last 21 years. I have a heart for education. I taught a college-certified financial literacy course for a while, have spoke to investors literally across the country, and now on the radio. I'm blessed with a lot of great listeners and clients that I get to talk to on a regular basis. I meet with folks from every walk of life. People who are young and just getting started to folks that are retired. I have clients with very little or even underwater in debt, where I help them get out of debt faster by using tools like Your Personal Bank to create positive arbitrage. And I have clients worth well over $100 million who are successful business people. I understand I'm blessed and rather unique that I speak to folks from coast to coast. When somebody's doing something, whether it be an investor or a business, it's hard to lie to me, because I'm looking at financial statements and tax returns on a regular basis. I'm not saying this to brag, but it's rare that I run across the situation with a business or investing situation or challenge or idea that either I haven't run across myself personally or have had multiple clients deal with. I'm in a rather unique situation, having a varied entrepreneurial and financial background to strategize, give people different perspective, oftentimes help them make better financial decisions. I consistently share with my clients that if you have a major financial decision to make, call me, text me, email me, or we'll even schedule a Zoom call, because I'm not necessarily going to tell you what to do or not to do, but I can be a good sounding board or bring up a perspective or an idea, a thought you may not have considered, whether it be a tax consequence or maybe there's a different opportunity or different direction to approach a situation or a challenge or a major decision. And when I work with clients, I often get asked this question. I understand you're busy. Yes, I am, but not too busy to help people and work with them, because that's what I do and that's my passion. And part of the reason I'm able to work with a number of people is early in my career, I used to do annual reviews with clients, like most people in the financial world do. And what I found is about 80% of the time, those annual reviews were just a waste of time. And what I mean by that is nothing had really changed in their lives. It was good to get together and go over things, but nothing had really changed. And because we primarily focus on financial products that are insured and guaranteed, even tax-free, highly liquid, safe, there's rarely any emergencies. The common joke in the industry, if you're in the financial world, is every time the stock market has a hiccup, you've got 30 people calling you and you have to calm them down. I don't have that challenge. They educate people, help them understand what they have. Look, I'm not expecting you to be an expert, but I do want you to have at least a basic understanding of what you're doing and why. And since we, again, focus primarily on safe and guaranteed assets, this is the golden era of fixed assets. You don't have to worry about your portfolio going down. We have products with unlimited upside potential with no downside risk. And particularly in times like this where we have historic valuations in the stock markets, that's of significant value. But the point I make is when I work with clients is I treat them like an adult. I say this all the time. You're a big boy or girl, and I'm going to treat you as such. And I'm not going to dictate on high what you should do. I'm going to educate you both the strengths and weaknesses or limitations of any financial tool. There's no such thing as a perfect financial tool. It doesn't exist. Each has strengths and limitations. I freely and openly share what those are and help you make a decision that's the best fit. What's the best tool for you? And again, how I can work with a number of people is I don't know when you have a financial decision or challenge make in your life. Contact me when you do. We'll chat. I have some clients I literally talk to on nearly a monthly basis because they have so many things going on. That's okay. Others I may not hear from for 2 or 3 years even because nothing has changed. And what I found by using that approach is each time we do meet or discuss things, we're not wasting any time because there's something to talk about. And my clients appreciate that. So my approach is maybe a little different than what most people are familiar with, but most of my clients find it quite refreshing, and it's why we have a very, very high retention rates of our clients. Last time we checked, it was over 98.7% 5-year retention rate, which is extraordinarily high in this industry. I have over 5,000 clients in our agency, and this is my 26th year. So if you're looking for maybe a different approach than what you've experienced in the past, more thoughtful, more educational approach, you maybe want to understand a little bit more about what you're doing or what your money's doing, or bring some perspective or products or ideas you may not have been introduced to before, like your personal bank. That's the title of the show. I do work with other financial products, but what I find is your personal bank is the one that's least known and least understood. Not that it's a big secret. It's just a financial tool that's been used primarily by institutional investors, banks, etc. And the vast majority of retail investors, as Wall Street likes to refer them to, rule of thumb, that's someone with less than 10 million in liquid assets or less, have never been introduced to these ideas. My higher net worth clients typically have, and we do work with them. So whether it's your personal bank to create high cash value, dividend growth, insured, with guarantees, tax-free, highly liquid, create positive arbitrage, or you want to reduce market risk, you want to have unlimited upside potential, yet protect your principal. We have financial tools that'll do that. If you want to create a guaranteed lifetime income like a pension check, some of the best numbers we've seen in over 40 years. I've got companies that are paying upwards of 30% signing bonus and will increase your income guaranteed by upwards of 9% per year each year you defer that income. If you have highly appreciated assets and you're wanting to defer the capital gains, there's a number of ways of doing this with tax planning. Look, I don't file tax returns. That's the role of a CPA or tax advisor. But we do a lot of tax planning, and all that is looking at if we make this move or reallocate there, we can reduce your taxes next year, for example. Do a lot of that. And yes, you can reduce capital gains on highly appreciated assets. There's a number of factors involved. It depends on what type of investment tool they're in, what your income is, whether you're charitably inclined or not. May use a charitable trust, for example. There's premium financing, another tool where a lender will fund a high cash value policy on your behalf, have unlimited upside growth with downside protection, principals guaranteed, and little or no out-of-pocket on your part. You might pledge a few assets temporarily for a few years, but now you have an asset that's building with little or no of your own money committed to it. There's so many options out there that most people are not introduced to. And that's the focus of Your Personal Bank. And lastly, I do sprinkle in some financial literacy, because I find, in general, most people have little or no financial literacy education. Wasn't taught in the home in most cases, certainly not in school or at your place of work, your business, your financial institution. It's rarely taught in church, even though that's one of the biggest topics in the Bible, for example. So hopefully that gives you a little idea of my perspective, my purpose, my goal. I have a heart for education, as I said, and my goal for you is to help you make better financial decisions for you and your family and your business. If any of this sounds interesting to you, or you want to find more information, you can go to my website, yourpersonalbank.com. We also have a free app you can download, the Your Personal Bank app. There's additional information on both the website and the app, and you also can listen to any of the previously recorded shows. Each has its own title. We focus on very current topics. There's a lot of government policies, what's going on in the economy, the Federal Reserve. Try to keep it interesting, not boring, but very current to keep you up to speed so you can make better financial decisions. That's the purpose of this show. So again, all the new listeners with all these new stations, I welcome you. I hope you become a regular listener. And those that have been listening, thank you. I truly appreciate it. I'm honored that you spend your time with me. And my hope is that time is valuable for you, that you learn something, that you benefit from this. I'm going to encourage you to stay tuned in the next segment, because we're going to get to some of the news of the day.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. If you've been listening to this show for the past month or so, I've been discussing quite a lot about the current market, the fact that valuations are at all-time highs. This goes back all the way to the 1840s. Regardless of how you want to measure the markets, PE ratios, or any other measure you want to take, they're the highest levels ever seen, ever recorded. This includes even 1929 and 1999. As the markets continue to climb, my level of concern increases. The risk continues to increase. Initially, I wasn't sure if we were truly in an AI bubble or not yet, but as each week passes, I'm increasingly becoming convinced that we are in a bubble, and this bubble continues to become more and more severe. And up to this time, I really didn't feel like the tech companies, which have been the center of this AI tech bubble, were really actively contributing to the high valuations until recently. Certainly they were promoting the hype, which was part of the cause for the extraordinary high valuations. But now many of the tech companies are actively contributing to the inflated valuations. And here's what I mean by this. You see, each day, the AI space is looking more and more like the home mortgage securitization at the peak of the housing bubble, with overlapping series of capital conveyor belts. It's called circular financing. And here's what I mean by this. Recently, Oracle signed a multi-billion-dollar contract with several customers. They announced a $450 billion contract backlog. But it turns out newly surfaced internal documents paint a very, very different picture. Oracle's AI cloud margins are razor thin. They're only about 14 cents a profit for every dollar in NVIDIA server rentals. Now, 14 cents on a dollar of profit is less than most retail businesses in terms of their profit spread. And it turns out in some cases, Oracle is actually losing money. Oracle's internal data shows profit margins fluctuating between 10 to 20%. Oracle also reported losing nearly $100 million last quarter renting out computer chips, which happens to be the very product driving the quote-unquote AI boom. See, it looks like this AI boom is unstoppable, but much of it is now being powered by creative financing or circular financing. To look at this a little further, OpenAI is currently making about $4.5 billion in revenue and has net losses of $13.5 billion a year. Its operating losses are about $7.8 billion per year. Now, this deal with AMD and OpenAI, which was touted as this great deal for both companies, Oracle stock went up like 25% overnight, literally, has a number of limitations in it, where OpenAI gets free shares for buying and building out 6 gigawatts of data center capacity using AMD chips. Here's the problem. Where is OpenAI going to get the money to do this? 6 gigawatts of data center capacity is massive. The amount of electricity to generate that is something like 2 Hoover dams or 4 nuclear power plants. This is not a small deal. And OpenAI made a similar deal prior to that with NVIDIA, where NVIDIA promised OpenAI $100 billion if they could build out, if OpenAI could do it. Which begs the question, AMD and NVIDIA are competitors. What is OpenAI going to do? Borrow the money to build the data center with NVIDIA chips and then turn around and reinvest that to build an AMD data center or a data center with AMD's chips? The combined deals would require 17 gigawatts of AI data center capacity just for OpenAI, one company. And it would require 2 competitors to work together, NVIDIA and AMD. Some are saying that Sam Altman, the CEO of OpenAI, trying to play both sides of the coin before anyone realizes what's going on. These competitors are not going to help each other. That's unrealistic. You see, these deals are creating massive headlines, huge hype, probably helping them borrow more money. But, you know, when debt becomes an investment, quote unquote, investment then becomes growth and Wall Street gets excited. These are all things that can blow up quite quickly. And if you really dig in further, the AI boom has created a circular economy where the biggest winners are essentially funding their own customers. It's like a game of musical chairs. And this is something that could affect over a quarter of the S&P 500. And why this is so concerning is circular financing, which is vendor financing, is what caused the destruction of Cisco and Nortel back in the dot-com era. These were companies that were actually profitable back then that got destroyed. And someone that would probably know best is the former CEO of Cisco. See, in the dot-com era, Cisco was a profitable company, multi-billion dollars of profit. At the peak, it became the world's most valuable company. Sound familiar? It was worth over $500 billion in March of 2000. That was real money. And then when the dot-com bubble burst through the circular financing and many of the similar creative financing that we're seeing today, Cisco, a profitable company, lost more than 80% of its stock value. In fact, 25 years later, Cisco's stock price has still not reached the peak of where it was at in the dot-com bubble. John Chambers, the CEO of Cisco at that time, did an interview recently, and he had some very valuable insights. He stated AI's transformative powers he sees very similar to what was the internet revolution. And he was asked, does it remind you of the internet boom of the 1990s? And his answer was absolutely. There are a lot of parallels. As he pointed out, in the internet age, there was an irrational exuberance on a really large scale. And in this AI one, there's a lot of tremendous optimism that indicates a bubble for a number of companies. These companies will become a train wreck if they aren't able to translate the technology into a sustainable competitive advantage. Like he said, how are you going to generate revenue after all the more money that was poured into it from investors? He predicts half of the Fortune 500 companies will disappear. They won't have the skills to adjust to this new innovation because AI innovation moves so quickly. What used to be a 5-year cycle is now a 1-year cycle. And many of these companies and leaders will not be able to adjust. He finishes up with his interview with stating, I think the next 5 years are going to be really bumpy and dangerous. That's from the CEO, or the former CEO of Cisco, the world's largest company at the peak of the dot-com boom. He has a rather unique perspective, I think. I still believe that AI will have a significant impact on the economy, much like the internet did. It fundamentally transformed our economy. The problem was the hype back then, much like I believe we're seeing now, is the hype led many people to believe that the innovation was just around the corner. It was coming soon. It didn't happen for about a decade after what most people, most investors believed. And I think we're going to see something similar here. And the bottleneck may not so much be the technology, but it's becoming increasingly clear that the bottleneck will be the infrastructure. You see, AI requires a tremendous amount of power. And for the most part, that means electricity. One of the challenges of the EV mandates, the electrical cars, was trying to convert a substantial amount of our transportation to electric was problematic because we didn't have the electrical grid to support it. We saw the effects of that not too long ago in California, for example, where they had some hot days and they didn't have enough electricity to support all the needs, the electrical demand. And they asked people not to charge their electrical cars during the day, for example. And although California had adopted electric cars more than most parts of the country, it was still a very small percentage of the total vehicles on the road. Yet the electrical grid couldn't handle even that small percentage. Well, AI is much, much bigger than that in terms of power needs. Sam Altman, the CEO of OpenAI, has stated that just to run ChatGPT for the future iterations of it, that they need trillions of dollars of infrastructure and data centers. Where's the power going to come from all of this? These deals are requiring multiple nuclear reactors or dams. You just don't build those overnight. It takes years, sometimes a decade even or more, to build a nuclear reactor. Even if they shorten the time frames on some of the permits, it's still going to be years to build the infrastructure needed for AI to do what they want it to do. And to kind of finish on that thought, AI data centers are now set to consume over 1,600 terawatt hours of power by 2035, which is equal to about 4.5% of all global electricity. In other words, the power demand from AI data centers is set to quadruple over the next 10 years. If it was counted as a country, the power demand for AI data centers would rank 4th in the world, only behind China, the US, and India. That's how big of a deal we're talking about. And that's why many are now saying AI growth will soon be limited by energy, the lack of energy. What does this mean for you? As more people come to realize this, some frustration will come in from the challenges and the delays and not living up to the hype and the extraordinarily high valuations we're seeing. See, everything right now is priced for perfection. If it's not perfect, valuations will adjust and could adjust quite severely. Scale out. Reduce your market risk. That's what professional traders and institutional investors do. They say you can't time the market. No, you can't pinpoint the date that's the peak, but you certainly can identify the season of when risk is elevated, and you can start reducing your market risk. Your personal bank, annuities, other tools like that can still allow you unlimited upside potential with no downside risk. If you want more information on that, contact me at yourpersonalbank.com. Stay tuned in the next segment. I want to share some more things about what's going on with the economy.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com. Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me at yourpersonalbank.com. JP Morgan's chief of global strategists issued an urgent alert stating the market is just blindly moving higher amid deteriorating economic fundamentals. I shared in the last segment that the deeper you look, the more fragile this AI hype boom starts to feel. You see, big tech's AI spending has exploded, and capital expenditures are through the roof while free cash flow is barely moving. These companies are burning through billions of dollars of cash. Meta and Amazon, for example, are burning billions just to try to keep up. Oracle, as I stated earlier, is already negative, borrowing a lot of money. And even NVIDIA, the poster child of this AI boom, is seeing free cash flow flatten as spending continues to increase. The cash is getting squeezed from every angle, and AI is eating money faster than it's creating it. It's all starting to look like a game of self-financing. Everyone's funding everyone else to keep the show running. As many are saying, the tech will likely deliver, but not for another 5 to 10 years. Will these companies' balance sheets survive long enough to see the benefit? And the concentration is unprecedented. It's the most concentrated instant market cap expansion in history with no proven future revenue or cost or earnings models to back up the investments or the valuations. The majority of the stock market and this country, the economy, in fact, is just becoming one big bet on AI. That's an incredible amount of blind faith on something that is unproven. Data centers, it estimated, are currently facing an $800 billion revenue shortfall and a 50 gigawatt energy shortfall. Those are massive numbers. This is so significant that a Harvard economist, without data center infrastructure building, GDP growth for the first half of 2025 was flat or zero. And the bubble in the market is unprecedented. Turns out the U.S. stock market cap to M2 money supply, this is the total amount of money in circulation in the United States, is now 300%. In other words, the U.S. stock market is 3 times more valuable than the total amount of money in circulation in the United States. This is the highest mark ever recorded. It's mind-blowing, actually. It's unprecedented territory we're in. And to make it matters even more concerning is technology and tech-related stocks now reflect 56% of the stock market valuation, which is 5% higher than the peak of the dot-com bubble. If we see a correction in the tech sector, this will have massive impact on stock market valuations. And the focus on NVIDIA alone, do you know it now represents 5% of the valuation of all the stocks in the entire world? NVIDIA as a company by itself is more valuable than the entire Japanese stock market, which is the 3rd largest stock market in the world. NVIDIA's valuation is now larger than France and Germany combined. NVIDIA is dominating the world equity market. What happens if and when NVIDIA stumbles? And to put things in a little bit more perspective, the AI bubble is now 17 times the size of the dot-com bubble and 4 times larger than the subprime bubble prior to the Great Recession. I mentioned at the end of the last segment what to do. When risk is elevated, what professional investors, institutional investors do is they scale out. They don't move all their money in or all their money out all at once, typically. They tend to scale in and scale out because they themselves understand timing the market is impossible. You can't pick the top or the bottom, but you can identify the season. You can understand when risk is elevated. And one measure of that is something called RSI, or Relative Strength Index. It typically maxes out at about 80, and the lowest readings are typically about 20, with 50 being neutral. So a higher number means it's overbought or overpriced, and a lower reading means it's oversold or underpriced. One of my listeners who's been in contact with me shared that when the S&P 500 hit an all-time record of PE ratio, he moved 80% to cash. He kept 20% in place for potential continued upside gains. Just this week, he texted me that when he saw the RSI, the Relative Strength Index, hit 80, which is typically as high as it ever goes, he moved to 90% cash. He's only 10% still invested. This is how professional and institutional traders or investors operate. There's no reason why you have to stay in and ride the roller coaster, whether it's up or down or whatever it may be. Most realistic scenario going forward is going to be significant volatility. The market rarely moves in a straight line, up or down for that matter. There'll be a lot of head fakes. There'll be questions is this the drop or is it going to bounce back? There'll be all types of questions. And that's why the scaling in and scaling out moves works so effectively. Warren Buffett himself has moved much of his investments out of risk. Now, he's not in cash. He's actually in bonds. He's getting some interest on that, as are many others that I work with. It's just smart. While you're waiting, you might as well earn some interest. Sitting in cash typically doesn't make a lot of sense. Your personal bank is a great tool for that, highly liquid. You can earn 6% plus guaranteed tax-free while you're waiting for the next opportunity, and then you pull the trigger. The most common concern I hear from folks who are looking at it, recognizing that stock market valuations are at extreme highs. That's undeniable. The risk level is elevated. Again, undeniable. But then their concern is, well, if I do sell out of this position, I'm going to incur capital gains taxes, or I'm going to incur taxes. Now, I'm going to share some of the things that you can do to mitigate those taxable gains. There's various different methods that can be utilized. Some of that is dependent on your income or type of accounts you have. And this is a point where I would encourage you, if you're driving, you might want to pull over for the next few minutes. I'm going to share some thoughts that I think you'll find extremely valuable. If you're not able to do that, you can always go to the Your Personal Bank website or the Your Personal Bank app and go back and listen to this segment. But I'm going to share with you some of the things that a tax advisor would do and look at, so you'll know more than 95% of the people out there, and maybe some things a lot of people even listening are not aware of. Now, the first thing I'm going to say is if you have a taxable gain, that happens to be good news. Why? Well, you made money. You made a profit. You don't pay taxes on losses, do you? So there's that. So sometimes it makes sense just to pay the tax and move on. But if you do want to mitigate those taxes, here's some things to think about. First of all, what type of account is it invested in? Is it a qualified account, IRA, 401k, that type of thing? Or is it non-qualified, not one of those types of things? If you're in a qualified account and you liquidate your positions because you want to mitigate or reduce your market risk, there's no tax consequence. It's inside that qualified account. Now, you could roll that over to an annuity, for example, and continue to earn unlimited upside gains with no downside risk. You could roll that over with no taxable consequence, whether it was a Roth or a traditional IRA, 401k, and that can be a tremendous way of continuing to benefit from the upside while eliminating the downside risk. Therefore, you've locked in all the gains that you received up to this point. I have a number of folks doing that, and it's the golden era of fixed assets. We're seeing some of the best numbers we've seen in literally 40 years. You couldn't ask for a better time to do that. Now, let's assume your positions are invested in a non-qualified account or not an IRA, 401k type of account. You want to liquidate some positions because you want to reduce your market risk, but you have capital gains involved. Well, depending on your income, typically for a married couple, for example, about $96,000 taxable income or under, you can actually have a zero capital gain tax. A lot of people are not aware of that. We can look at your taxable income and see where you're at, and you may be able to sell some positions, highly appreciated assets, where you have zero capital gain. If you want more information on that or look into it, contact me at yourpersonalbank.com. But most people are going to find themselves in the 15% capital gains position. Now, again, 15% is less than earned income in most cases, so it's a better tax rate. But you could look at perhaps different positions you may have. Some would have more of a taxable gain than others, and you could perhaps spread it out over a period of time. Say you liquidated some positions here in 2025, and then again, after the first of the year, the following year, therefore spreading out the tax liability over a couple of years to help mitigate that tax hit, if you will. Also, you could use your personal bank when you sold those positions, put it into the policy, earn dividends, and then when the tax is due, perhaps say April of the next year, you can then borrow against the policy to pay the tax, receive positive arbitrage on that money, so you're still earning some interest on that money you use to pay your tax liability. Over time, you could see some of that money come back in interest over time. That can be a tremendously powerful tool to mitigate the cost of the tax. If you want more information on it, contact me at yourpersonalbank.com. But let's assume your capital gains tax liability if you sell positions are significant. hundreds of thousands of dollars to even millions of dollars. I have clients in those positions. Well, folks, there's ways to defer the tax on those also. Since I'm coming up on a hard break, I'm going to have to share that with you in the next segment, so stay tuned.
Stay tuned for more common sense from Ferenc. For more information, contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ferenc, host of Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So if you were listening to the last segment, I was covering a number of ways to mitigate capital gains tax on highly appreciated assets. It's undeniable that asset valuations are at extreme high levels, historically high. The risk is elevated as a result. Many people are becoming concerned that we are in a bubble that could correct itself, perhaps even violently, in the near future. Therefore, they're wanting to mitigate or reduce their exposure to that risk. But the concern is, if you have some assets that have increased in value quite a lot, there may be some real tax implications. If you missed the previous segment, I'm going to encourage you to go to yourpersonalbank.com or the Your Personal Bank app and go back and listen. I covered a number of different scenarios, depending on whether it's qualified monies, IRAs, 401ks, or not. Also, factors are your income. Some may be able to sell some of your appreciated assets with zero capital gains. Others, using your personal bank, could mitigate some of those costs over time, reduce them. But even if you have significant capital gains, hundreds of thousands of dollars or even millions of dollars, and if you're charitably inclined, there's a number of charitable trusts that you can employ. Charitable remainder trusts, for example, are a very popular tool where you can defer the capital gains over a period of up to 20 years. Typically about 10% of the total assets ultimately end up going to charity. There are some costs involved in setting up the charitable trust. We have attorneys we can recommend that can do that. Your costs are going to be somewhere around $5,000 to establish that as one time. And the other costs would be filing an annual tax return, which is fairly simple, but you do want to have a tax advisor that understands charitable trust. But the main benefit is you could defer your capital gains over up to 20 years. That could allow your assets to grow significantly over that time frame, and you can mitigate your risk by reallocating the funds to, say, something more conservative or less volatile. Funding an insurance policy from some of the proceeds you receive could significantly reduce taxes for yourself or your heirs. So there's a number of things that could really benefit and mitigate, and these are the type of strategies that are not typically employed by most financial folks. It's just not an area, it's not their fault, it's just not an area of expertise. This is the type of thing I deal with on a regular basis. So much like I shared in the first segment, welcoming a number of new listeners from a number of new stations. Welcome. Those that have been listening for some time, I appreciate it. I'm honored. But you can start to recognize that we're able to bring some strategies, whether it be reducing market risk, reducing or mitigating taxes on gains, or helping you plan accordingly. If you're going to invest in, say, highly appreciated assets, wouldn't you want it to be in something that would be tax favored? I've shown folks who have invested in highly appreciating assets in one type of account and showed how they could do partial conversions over time, say over a couple 3-year period, and significantly reduce their future tax liability. These are the type of things that are not typically brought to investors' attention. And I deal with this on a regular basis. Where are things headed from here? Well, according to CNBC, the S&P 500 recently has posted a rare 33% rally in the past 6 months. And as they state, the gains could get tougher from here, and historically that has borne out to be true. And another one of the concerns, again, the concentration of not only the companies that this rally has been focused on, frankly, about 10 companies. The other 490 of the S&P 500 haven't gone up all that much in the last few years. But there's also a concentration of U.S. household wealth. It turns out that U.S. households hold a massive 80% of their assets in equities, which by far is an all-time high and is much higher than even the dot-com bubble. Therefore, a poor result or a correction in the stock market would have devastating impacts to the U.S. wealth. And here's another red flag or a canary in the coal mine. U.S. heavy truck sales has dropped to the lowest level since the 2020 crisis or the great financial crisis. Truck sales have fallen over 100,000 in the last 2 years. It's rare that a drop like this occurs outside of a recession. And all of these different reasons that I've been discussing on this show, not only this week, but the previous month, frankly. This is why some heavy hitters have really started to warn about an AI bubble, including Jeff Bezos of Amazon. Goldman Sachs CEO David Solomon has recently warned of a stock market drawdown, and he said people are not going to feel good. Some others have even referred to, we've now reached the stage of the bull market that Warren Buffett has warned us about. Here's something quite interesting of where things may be headed. It turns out that when the S&P 500 Shiller PE ratio goes above 30, each time after, it was followed by a negative 10-year annualized return. A decade without gains. Remember the lost decade after the dot-com bubble? And the Shiller PE ratio this time has hit 40 plus. That's why this financial article states AI is poised to gut your retirement fund, according to analysts, and they go on and say few will escape the pain. As the Washington Post observed, speculative investment in the AI bubble is now the dominant force driving the U.S. economy. It's a major red flag. The effects on the stock market will be dramatic, and they're pointing out to a 30% or more drop in valuations. This will, as they pointed out, gut retirement funds. When the correction occurs, how long does it take to recover? Well, we have a number of examples. The 1907 panic took 10 years. The Great Depression, 25 years. The 1973 oil shock was 9 years to recover, to get back to where you were. 1987 Black Monday took 2 years. The 2000 dot-com, the NASDAQ dropped 78%. So if you were in the NASDAQ, tech stocks, where a lot of people are today, it took 15 years for that to recover. 2008 financial crisis was 5.5 years. The 2022 bear market took about 18 months. The 2020 crash, which was created from the COVID shutdowns, so it was an artificial creation, that one recovered in only 6 months. If you look at all these time periods over the last 125 years, the shortest correction was about 18 months and the longest was 25 years. Many were in the 5 to 15 year time frame. And I ask people a simple question that are invested at risk to a market correction. If the market corrects, are you willing to wait 5, 10 years, maybe even longer, for you to get the money back? In other words, get back to even. If the answer is no, there's another option. Scale back, like professional or institutional investors do. Pull back some of the market risk and put it into something that'll grow, continue unlimited upside gains. Your personal bank annuities offer that with no downside risk. If you have capital gains taxes due to the increase, well, one, you made a profit, so be happy about that. But there are multiple options we may be able to explore to mitigate or defer those capital gains. Another strategy some people use is they take their principal off the table, the money you contributed. That way you're playing with house money. So even if it went down, at least what you lost wasn't your money. That's another strategy. But whatever you do, if you're uncomfortable with the level of risk that is now inherent with this current market, I encourage you to look for ways to mitigate that risk. That's what I do. That's my specialty. That's what I've been doing for the past 26 years. And oftentimes, I can help you mitigate the cost of the tax, the capital gains tax or whatever, through the process of doing that. And the last thought I'll give you on those taxes is if you do indeed, say, have a 15% capital gains tax on some gains, we all know that in a matter of weeks, the market could lose 15%. So what are you really giving up? It's that fear of missing out. Yet, you could still continue that unlimited upside gain, as I stated before, with your personal bank or annuities. Eliminate the downside market risk. If this sounds interesting to you, or you would like more information, I encourage you to contact me at yourpersonalbank.com. Stay tuned next week to some more great information. And as long as it's on our money, in God we trust. This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states.
Concerned about market risk? I'm Ferenc Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ferenc at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.